Hello, my name is Eyal. This is a webinar of Better Trader. In this webinar, we will talk about the risk index. It's real-time monitor for the sentiment in the market. If it's positive sentiment, we call it risk on. If it's negative sentiment, it's called risk off. The base idea behind the risk on risk off real-time monitor is that you can gauge the sentiment in the market, not only from single market like S&P 500. You want to gauge it from few markets and even from asset classes. It means that where the sentiment is good, usually, and there is a good mood, S&P 500 goes up, US 10 years go down, and so on, so on. Currencies, those currencies goes up, West Texas oil goes up, and gold goes down. So in this case, when there is good mood in the market, you usually like to participate in long trades, for example, for S&P 500. And if there is bad mood in the market, according to the risk index, it's maybe better not to try to buy the dip of the S&P 500 as a trader because it takes time for the mood to flip direction. So we build this in several steps, and we work with very close with hedge funds managers and traders to construct the risk indicator that will be very good for day traders, for active traders. If you trade intraday, this is probably for you. It probably can help you. If you trade cross like between days or swing trading, it's less for you. So let's focus about the component and some ways to use it. First of all, I will say there is no one way to use the risk index. We see that different traders use it in different ways. I will share some of the mechanics that this work and how you can apply simple rules to your trading. The idea is that like trade ideas like support and resistance level is another tool to use in your trading. So not to buy or sell just based on this, but it could be combined with trade ideas, it could be combined with economic events, it could be combined with support and resistance level, trend lines, and so on. Okay, so the risk index, as for now, it's basic and 4 hours time frame. It means it's more for day traders, intraday. And if you're a scalper, you can even choose like a short term, like 1 hour. But 4 hours, if you trade for trades between 5 minutes to 3 hours, it's pretty good. And the idea is that each component here, each asset class, represents asset class, and it's showed the right direction of the mood. So it means that if S&P 500 is going up, you will see the S&P 500 green. But if gold is going up like here, you will see the gold uh, going red because it signals less uh, of the good mood and more like concerns. And the same with the US 10 years. When it's heading up, you see it's in red. And when there is momentum down in this instrument, you will see it green. So all the colors here are already converted to the mood. So if you see red, it means bad mood in the market. And if you see green, it means that it's good mood in the market. It's not mean that like specifically each instrument going in this direction. Now, how to use it? Let's assume that you trade S&P 500. You don't want to trade only based of S&P moves. You want to see if you can get some clues from other asset classes, for example, from gold and from US 10 years and from currencies and from oil. So you can open all these charts all the time and track it, but most of the time nothing happens like we see now. The risk, the total, the big picture, it's about 3%. It means that no one really care about any direction in any market, and for sure not in all the market together as the mood in the market. So when it could be useful, for example, when this number here, the aggregation, the plus 4, crossing plus 15, this signal, okay, there is some trend here all over the market that the aggregation is more than 15. And if it's heading 25, it's pretty positive. So, for example, I don't like to go short S&P 500 when these numbers it's more than 15 because it means that I'm start to get against the trend not only of S&P 500 against the trend in the money flow between asset classes, and this is much stronger than me. So I would consider long trade when it's above 15 and for sure above 25, and maybe this is the time to get into the market combined with another indicators or another levels or some pattern or technique that you already have. But for sure, for me, it's signal 100% not to go short because I don't want to go short S&P 500 when I see the risk index, which represent many asset classes, crossing plus 15, plus 25. It's not the time to be counter market. The same for the negative side. When here the numbers will be minus 15, I don't want to try to buy the S&P 500. I will wait for less pressure all over the markets, all over asset classes. And when it's going like between crossing down minus 25, again, it could be that many markets like S&P went down a lot, but I don't want to try to catch this. I wait for some regression into the zero area or to short again the S&P 500 because the trend could continue another leg or to be long. But for sure, I don't want to be long S&P 500 when here the number is minus 25. Um, Many times we get the question, what is this SD? And then 11. This is the standard deviation. How much uh, this basket it's concentrated on the same direction. And you see, let's talk about it like this: S&P 500 could be plus 100, and gold could be minus 100. It means that something happened, but you can see that the number here is low because they canceling each other. So this is the reason when you see low standard deviation, it means that the difference between of them, the directions, it's um, good. It's not big, which is mean that they playing the same music and it's more uh, let strong. So this number more reliable as long as the SD is lower. So if here it's 6 and the SD is 50, it's less reliable it's than 6 and 15 because 6 and 15 I know that really nothing happened. But if it's 6 and 50, it means that probably S&P is very positive and gold is very negative. So they canceling each other. There is some story that's running in the market that caused both of them to react so strong, and this is the reason the standard deviation will be high, like 50 or something like this. So the standard deviation, you will start to get used to it uh, once you will keep using the product, and these numbers like under 20, it's pretty good um, reliability of the basket. The idea is to give you the clue which market is start to be positive. You can see it here very like signal positiveness in the market, which market is lagging. So sometimes you will see that oil is going up and gold become green, like green. It's been positive. It's been going down
New tweet of Bloomberg Markets.
way before the S&P 500 participants. So you can see the risk indicator plus 15, gold and oil representing very positive mood, and S&P is still consolidating. So if there is some support level, this is sometimes a good time to pick up the S&P 500 as the lagging market. So we have some clue from other markets about the mood in the market, and then you can catch the S&P 500 as the lagging instrument and wait even for some trigger to do it, or so you can get into the game once you see that you have some clues from other markets, and this practically reduce your risk. This is the risk on risk of um, webinar. If you have any question, always feel free to reach out to us, to John by the chat, and you can reach out by email or any other way that you feel that you need help or have questions. Thank you very much. This is the webinar about the risk on risk of real-time monitor. Thank you.